Welcome to Market Brief, After Hours. It has been a fascinating day on Wall Street, with a lot of moving parts for investors to digest. We saw major U.S. stock indices closing higher, driven by some impressive gains in big tech, alongside some very encouraging signs that inflation might finally be cooling down. Let's start with the big picture. How did the major U.S. indices wrap up the session?
It was a solid day across the board for U.S. equities. The S&P 500 rose 0.38% to close at 7,572. Meanwhile, the tech-heavy Nasdaq Composite climbed 0.62%, settling at 26,269. And the Dow Jones Industrial Average added about 150 points, which is a 0.29% gain, ending the day at 52,659. What's really interesting about today's action is the rotation we saw. Investors seem to be pulling back from semiconductor stocks and rotating heavily into mega-cap big tech names.
That is a notable shift. Which tech giants benefited the most from this rotation?
Amazon and Alphabet both moved up around 3%, and Microsoft was higher by nearly 3% as well. But Apple was the real standout, gaining 4% and hitting a new all-time high. On the flip side, chipmakers had a rough session. Micron Technology shares fell 8%, while Lam Research and Advanced Micro Devices both dropped 3%. Intel fell more than 4%, and the VanEck Semiconductor ETF shed over 1%. So it was a very clear divergence between hardware-focused chipmakers and the broader software and consumer tech giants.
And this market move happened against a backdrop of some highly anticipated economic data, specifically on the inflation front. What did the latest reports show us?
We got the Producer Price Index, or PPI, for June, and it unexpectedly fell by 0.3% month over month. Economists were actually expecting it to be flat, so a decline is a pleasant surprise. On an annual basis, producer inflation came in at 5.5%, which is well below the 6% we saw in May, and lower than the 6.2% forecast. If you look at core PPI, which excludes volatile food and energy costs, it rose 0.2%. below the 0.4% forecast, bringing the annual core rate to 4.7%. This was actually the first monthly decrease in overall PPI since August of last year, and the largest drop since April of last year, largely driven by a 12% slump in gasoline prices.
That PPI report came right on the heels of some cooler consumer inflation data earlier in the week, didn't it?
Exactly. Tuesday's Consumer Price Index, or CPI, fell 0.4% in June, bringing the annual increase to 3.5%, which was lower than the 3.8% economists had projected. All of this has really bolstered hopes that the Federal Reserve might not need to be as aggressive with interest rate hikes. In fact, Treasury yields reacted sharply. The 10-year Treasury yield fell to 4.583%, and the policy-sensitive 2-year yield dropped over 7 basis points to 4.185%. Following the CPI report, the market's implied probability of a rate hike at the July meeting fell from 42% on Monday to just 17%.
That is a dramatic shift in expectations. But does this mean rate hikes are completely off the table for the rest of the year?
Not necessarily. While the July hike looks much less likely now, traders are still pricing in a nearly 60% chance of a quarter or half percentage point increase by the October meeting. New York Fed President John Williams did give a speech saying there are encouraging reasons to expect inflation has peaked and will edge down. But some analysts are warning that these numbers are still well above the Fed's 2% target, so the market might be reacting a bit too strongly to individual data points.
We also saw some other domestic economic indicators today, like manufacturing and housing. How did those look?
It was a bit of a mixed bag. On one hand, manufacturing activity in New York State grew much faster than expected. The Empire State Manufacturing Index jumped to 15.6 in July from 5.7 in June, easily beating the consensus forecast of 8.4. New orders and shipments were strong. On the other hand, the housing market is still feeling the pinch of high interest rates. Mortgage applications fell 2.7% for the week ending July 10th. The benchmark 30-year fixed mortgage rate ticked up to 6.65%, which ties for the highest level in 11 months, and that caused home purchase applications to drop by 7%.
Were there any key economic data releases out of Europe that influenced trading?
Yes, we got Eurozone industrial production data for May, and it was disappointing. Production declined by 0.2% month over month, ending 3 consecutive months of growth. Economists were expecting a 0.2% expansion. The decline was led by a drop in durable consumer goods and intermediate goods. Nationally, Ireland saw a sharp 5.2% decline, while Germany and Spain actually managed some growth. Speaking of Spain, their final consumer price index for June came in steady at 3.2% year-over-year, matching preliminary estimates, though monthly inflation did advance to 0.6% from 0.1% in May.
You mentioned geopolitical tensions. There was news regarding the U.S. and Iran that kept commodity markets on edge. How did oil react to that?
Oil prices were actually relatively flat despite some major headlines. The U.S. reinstated a naval blockade on Iranian ports near the Strait of Hormuz and conducted several airstrikes targeting military assets along Iran's coastline. Despite those actions, U.S. West Texas Intermediate futures for August delivery rose just 26 cents to settle at $79.60 per barrel, while Brent crude for September gained 22 cents to close at $84.95. It seems the market had already priced in a lot of this geopolitical risk, or perhaps traders are waiting to see if there is any actual disruption to physical supply.
Now, what about Asian markets? We had some major economic data out of China today.
Yes, China's second quarter GDP growth came in at 4.3%, which is the weakest pace we've seen since late 2022, and missed market projections. As a result, the Shanghai Composite dropped 0.29%. However, other parts of Asia fared much better, largely boosted by the cooling U.S. inflation data. Hong Kong's Hang Seng surged 1.40%, led by healthcare and biotech. In Japan, the Nikkei average jumped 1.49%, driven by short covering in semiconductor stocks like Advantest, which rallied 5.8%.
And South Korea's market had an incredibly strong session as well, correct?
Absolutely. The KOSPI index skyrocketed 6.24%, marking its biggest rally in nearly 5 weeks. This was entirely a semiconductor rebound story. Samsung Electronics climbed 6.3% on positive analyst outlooks for AI memory demand. SK Hynix soared 8.8%, and chip equipment maker Hanmi Semiconductor surged nearly 30%. Down in Australia, the S&P ASX 200 managed a modest 0.37% gain, supported by a weaker dollar that lifted mining giants like BHP Group, which rose 3.2%. New Zealand's benchmark index, however, slipped 0.12%, marking its third straight session of losses.
Let's transition over to the foreign exchange market. There were some massive moves in currency pairs today, especially with the British pound. Let's break down the technicals, starting with GBPUSD.
The British pound had an explosive session. GBPUSD surged 1.07% to close at 1.3534, forming a massive bullish engulfing candle that closed right near its session high of 1.3558. What makes this move technically significant is that the pair violently breached a cluster of key moving averages, including the 50-day simple moving average at 1.3385, the 200-day at 1.3397, and the 100-day at 1.3400. This breakout shifts the broader outlook from consolidation to a potential new upward trend. If it can hold above that 1.3400 level, we could see a test toward 1.3600.
That is a powerful technical breakout. Did we see similar strength in the euro?
The euro also attempted a rebound, with EURUSD closing up 0.38% at 1.1463. It found solid support near the 1.1300 to 1.1400 region, breaking a series of consecutive lower closes. However, unlike the pound, the euro remains below its key overhead moving averages. The 50-day SMA is sitting at 1.1542, the 100-day is at 1.1592, and the 200-day is at 1.1641. So, while the short-term momentum is shifting positive, the medium-term trend is still technically bearish.
What about the Swiss franc and the Australian dollar?
USDCHF fell 0.48% to close at 0.8051 as it pulled back from recent peaks. Despite this short-term correction, the pair remains comfortably above its key moving averages, with the 50-day SMA at 0.7958 and the 200-day at 0.7915, keeping the overall bullish structure intact. Meanwhile, AUDUSD edged up 0.48% to close at 0.7007. It is currently sandwiched between the 200-day SMA at 0.6879, which is acting as support, and the 50-day SMA at 0.7056, which is serving as resistance.
And how did precious metals perform amidst all this currency volatility?
Gold was very quiet, closing up just 0.08% at $4,055. It formed a narrow doji candle, indicating complete indecision.
Technically, gold is deeply depressed, trading well below its 50-day SMA of $4,336 and its 200-day SMA of $4,475. It is trying to establish a floor around the psychological $4,000 mark. Silver, on the other hand, faced renewed selling pressure, dropping 1.74% to close at $57.68. It is firmly bearish, trading way below its 50-day SMA of $69.29 and its 200-day SMA of $69.59, and it looks like it could test its prior lows near $56.
To wrap things up today, we have to talk about some massive individual stock stories that caught everyone's attention. Let's start with PayPal. What a day for them.
Yes, PayPal was the star of the S&P 500 and Nasdaq 100, closing up more than 17%. This massive surge came after reports surfaced that Stripe and Advent International have made a joint offer to acquire PayPal for $53 billion, which translates to $60.50 per share. That is a massive premium and sparked huge volume.
And we also saw a big rebound in the electric vehicle space with Lucid Group.
Lucid shares skyrocketed 29% today. This was a classic relief rally after management aggressively denied reports that the company was considering bankruptcy or looking to go private. They called those rumors completely false and reassured investors that they have plenty of liquidity to fund operations well into next year.
On the losing side, Pentair PLC had a rough day. What happened there?
Pentair was the biggest loser in the S&P 500, plunging 15%. The company cut its full-year adjusted earnings guidance to a range of $4.60 to $4.80 per share, down from its previous forecast of $5.30 to $5.40. That was a major disappointment for the market, as the consensus was sitting at $5.33.
A lot of dramatic moves to process today, from cooling inflation data to massive corporate buyouts and major technical currency breakouts. That is all for today's episode. If you find this useful, please follow Market Brief After Hours.